Welcome to our podcast on the house, where we dig into real estate trends with data and real talk. My name is Reena Agrawal, and I'm a senior research economist at Veros.
And my name is Eric Fox. I'm the chief economist here at Veros Real Estate Solutions. So today we're really going to be talking about probably the number one thing that at least I hear about,
Yes.
probably you as well, Reena, is the issue of why aren't house prices going down? We look at a lot of points in history, a lot of news articles that come out, and they say things like if sales are slow, if sales are sluggish, prices should be coming down. That just seems to be economics 101 theory. So we're going to investigate that today.
So you're right, that seems counterintuitive, right? That home sales are slow. We keep hearing that first-time home buyers are not buying, but why aren't prices falling? So we'll walk through that. We will talk about what is different now in the current housing market compared to what we saw in 2008 and 2009. And we will talk about the different regional patterns here. And to explain all this, we are going to talk about, like as you said, supply and demand fundamentals. We are going to talk about home seller behavior. We are going to talk about the structural factors that are keeping prices up right now.
Okay. Well, and as we start, maybe we ought to just set a few ground rules here. So when we talk about articles that we might read where it talks about house prices being stable or flat or increasing only slightly, what we mean is that national house prices overall, on average, are remaining relatively flat, relatively stable, going up on average very slightly over the past year.
Mm-hmm.
That's not to say, however, that there are not some markets in the United States where prices are going up fairly aggressively. And there are some markets where prices are going down somewhat. But overall, when we're talking about the housing market, we're referring in this particular podcast to the overall nationwide housing appreciation that's going on right now.
So to give an example to what you were just now saying, Eric, when we look at Veros's HPI or the home price index, prices in the US on average increased by 3.2% from August 2024 to August 2025. But if we look at the regional trends, home prices in Tampa fell by 1.3% during this time, whereas home prices in Chicago increased by 6.9% during this time. So here you see the different regional trends. Prices are falling somewhere, prices are rising pretty fast somewhere, but on average across the US, they're rising modestly. They're going up a little bit. So to explain all this, I think we need to talk about supply and demand fundamentals.
I agree with you, and I think maybe it would be good for us to go back in time and look at the supply and demand fundamentals that were in place when we did see some big house price shifts historically. So I think one of the biggest ones a lot of folks are thinking about these days is back in 2007, 2008, 2009. And for those familiar with that time frame, house prices in the United States plummeted. They went down by, in some cases, 20, 30, 40%. So it was a pretty dramatic decline. And I read lots of articles where, things are going to be very similar. It's getting ready to happen here now. But if we look at supply and demand, so economics 101, back in 2007, 2008, 2009, there was a huge amount of supply there because of lax lending standards, because of overbuilding by home builders, because of, easy qualification for loans. Everybody had a mortgage, everybody was foreclosing. The supply went up dramatically. At the same time, we were going into recession, unemployment was going up, and as a result, demand plummeted. So when you have supply increasing, demand plummeting, you're going to get prices that are going to go down significantly. So if we fast forward then to 2020, 2021, so during the early parts right after the COVID pandemic, what was happening there? What happened there is nobody wanted to sell their house. Everybody was hunkering down for the pandemic, staying home. And then there were lots of folks who lived in big cities that wanted to move to rural areas. So demand soared. So we have very low supply, very high demand. Economics 101 says that prices will rise rapidly. So we don't have either of those things happening right now. So we can't point to either of those scenarios as being a good indicator of what's happening today. So if we just look at supply and demand, what's happening today is we do have weak demand. No question about that. But for a variety of reasons, which we're going to get into, we also have very weak supply. Very low supply, very low demand means things are going to just sort of stay where they have been, which is precisely what is occurring right now.
That's right. So let me talk a little bit about why demand is so low. So when we talk about demand from the economic perspective, demand is not how many people are willing and wanting to buy a house. Demand is how many people can actually afford to buy that house, right? So who wants to buy a house? Folks who are renting, folks who are forming new families, folks who already have families. Some retirees want to buy a house, but can they afford that house? To be able to afford their house, they need to have good credit. They need to have a down payment. They need to have income stability, and they need to have manageable debt, right? So that considerably reduces the number of people who can actually afford to buy a house. And this is one of the factors why demand is so low right now.
Well, one interesting data point is the number of families who can actually afford housing. So the first-time buyer qualifying income earlier in 2022 was $106,000. That's up from $82,000 in the latter part of 2019. So that's a big increase. That's up almost 30%. So it almost seems like, what's the problem here?
Yeah, and a related data point is when you talk about 2019, the median house price in the US was $279,000. You fast forward to 2025, that median price has shot up by 52% to $423,000. So that is a huge jump in the median selling price in the US. So that kind of gives you an idea why many people cannot buy a house. To give a little bit more perspective about this, let's talk about these two imaginary situations. We have Maria, who lives in the Midwest. She makes $80,000 a year. And in the town where she lives, the median house price is $300,000. So given the current mortgage rates, it's feasible for her to buy a house, a median price house, given that she has good credit and given that she has some down payment saved up. But now you contrast it with somebody, Jason, he's living on the West Coast. He wants to buy a house there. His annual income is $300,000, but the median house price here is $1.2 million. So now, given the current mortgage rates, he's likely not able to afford that house because if you add up all the insurance premiums and the property taxes that go with it, it will make affording that house very, very remote. And so likewise, there are many other people who are not able to afford a house in such areas and they are priced out. So this also gives you a sense of what is happening in terms of affordability right now.
So if we shift gears and look at housing supply, really we've got supply that comes from two sources.
Mm-hmm.
One source, obviously, is somebody buys an existing house.
Right.
We call those resales. And then the others are when you're driving in the outskirts of a community, you'll see the new home communities, the new builders come look at our model homes, the new home construction. And so those two added together give us our supply of homes that are available on the market for consumers like you and me to purchase. So when we look at many markets around the country, especially in the Northeast and the Midwest, supply remains really constrained right now. Longtime owners don't want to give up their mortgage rates, their low mortgage rates. New development is very sparse. And so as a result, supply is very constrained in these parts of the country. And like demand, supply varies across the country. It's not the same. So like I just said, demand in places, supply in places like the Midwest, supply in places like Northeast is very limited. And so that's where we're going to expect the largest price increases. On the other hand, if we look at places like Texas and like Florida, supply is much more generous. There's been lots of new home construction in a lot of those areas. So there's a lot more supply. And one of the metrics that we use often for our modeling is called the month's supply of homes. And that says if we look at a given area, like Texas, for example, and we looked at how many homes sell on average in Texas every month, if there was no new supply that came on the market, how many months would it take to sell all of that inventory? And in Texas right now, as of this summer, there is currently a 5-month supply of homes. If we look at a place like Connecticut, however, which is in the Northeast where supply is more constrained, it's only 2 months supply. So we shouldn't be surprised when prices in Texas rose only 0.6% year over year, where prices in Connecticut rose nearly 8% year over year, simply because there's there's a big difference in the supply of homes in those two different areas. And if we look at periods of time where prices were very much falling, back in 2007, 2008, 2009, you might be asking, well, how many months supply were there back then? There were almost 9 months supply of homes. So even in our worst performing markets now, we don't have anywhere close to 9 months supply of homes. And so a balanced market is usually thought of to be between 5 and 6 months supply of homes. So even with that barometer, we aren't in any serious situation just yet with supply.
You're right about that, but there are some factors that may be distorting this supply-demand equation a little bit. So even though, like we said, there are 5-month supply or 2-month supply, what could be adding to that is, insurance premiums or property taxes, especially in older areas or in areas that are prone to flooding or other natural disasters. People cannot buy those homes because the insurance premiums are so high, or the property taxes may be so high that it kind of really distorts that supply and demand situation when you add these extra costs into the picture. And to give an idea about this, insurance premiums have gone up by 70% over the last 5 years. And property insurance premiums are now the largest growing segment or the largest growing component of mortgage payments. So much so that in some areas, folks who are spending on mortgage payments, 1 out of every $10 is going towards these insurance premiums. So this kind of lowers the affordability for many folks out there, and this may price them out from buying a home.
Well, one thing that's very interesting, we took a look at the data and we see that the typical home seller profile has changed considerably since the big downturn of 2007, 2008, 2009. Lenders increased lending standards. It's much more difficult to get a loan today than it was back in 2007. Back in 2007, 2008, sometimes people would say all you needed to do is sign your signature and you would get a mortgage of 100% of the value of a house. You didn't even have to have a down payment. Standards were very lax. That's certainly not the case today. So when we pulled the data, and I know, Rena, you pulled this figure, and I was really surprised. The typical FICO score, which is a median credit score that banks will typically pull when you go to buy a house, it was 710 back in 2008, and now it's 770. So that's a pretty significant increase in the quality of a home seller compared to nearly 2 decades ago. And the other thing which I found interesting was the debt to income ratio, looking at the households and how that's changed from the end of 2007 until today. It was over 100% back in 2007. It's now down to 68%. So that's really indicating that the typical homeowner today is in a very financially solid situation compared to what they were back in 2007, 2008. And many buyers that would have qualified back then don't qualify today. So it's just a very different market, and that's due to the lending standards.
So talking about homeowners and their financial situation, I have another facet of how solid their financial standing is. So many homeowners, as you know, they refinanced or they bought a home during the early days of the pandemic, and they managed to get mortgages at under 3%, under 4%. So right now what we see is that around 52% of all homeowners who have a mortgage, it's below 4%. Now, if you go back to 2019, just before the pandemic, that percentage was only 35%. And if you go further back to 2013, we don't have data for 2008 and 2009, but in 2013, only 20% of the homeowners had a mortgage rate contract of less than 4%. So now these homeowners, they are in a good financial situation because their mortgage payments are very low. They have no compulsion to sell their homes and buy another home at the high mortgage rate currently we have of 6.3%. So they have a very solid footing out there. And also 40% of all homeowners in the US own their homes outright. What that means is they have no mortgage. So they are in a very secure footing as far as, what home sellers are right now compared to what they were back in 2008 and 2009.
And I think your 40% is a very interesting number because nearly 40% of all homes are currently owned by baby boomers. So right off the bat, those folks have their homes paid for. They don't have an incentive that they have to move. If they don't want to downsize, they don't have to downsize. And as a result, many of them are staying put. And because their percentage of the population is increasing and will be until about 2030, we can expect this kind of behavior to continue for the next 4 to 5 years, perhaps, where there's going to be this supply constraint where this general group of the population isn't going to sell their homes. And that's going to keep supply tight.
So another very interesting trend that we are observing right now, which explains kind of why prices are sticky and they're not falling despite the housing market being slow, is that sellers are resisting price cuts. They would instead sweeten the deals by offering concessions. They are offering rate buy downs. They are offering to pay for home inspections. They are offering to pay for closing costs. So what this means is that what the seller is getting is lower than the headline price, right? So on the surface, it seems that the prices are remaining steady or they are going up, but actually what sellers are receiving is less than that selling price. So we observing this kind of pattern also, and it seems around 44% of home sellers in the first quarter of this year, they offered concessions so their homes could be sold. So this, I feel, is also an interesting factor which could be explaining why prices are not going down as much as we think that they should.
Okay, well, that's an interesting perspective. I know many years ago, I bought a condominium in a very large complex where investors, it was an investment property, where investors held a large number of the condominiums, and there was actually a management company there that would rent them out. And I remember one thing that they told me, which reminds me of this story, which based on what you just said, they told me, oh, our rents have been solid or increasing for the past 10 years. So then I get in, I rented to the first tenant, they rented for 6 months, and then the second tenant came in and we couldn't rent it at that price. And so they said, oh, let's offer them a 1-month concession, but we'll still keep the rent the same. And suddenly it dawned on me that's how they were able to say that. But the net effect was I was losing 1/12 of my rent because they wouldn't pay the market rate I was charged, the market rate that we were advertising. So same thing, I think.
Yeah, and another thing that is happening right now is that 1/3 of all homes are being bought with cash. So there is no mortgage involved. So there is no appraisal contingency. And what happens is we keep hearing that desirable homes are getting sold very fast, that they have multiple offers. So in such situations, when people are coming in with all cash offers, they are able to offer a very competitive price, right? So this keeps the benchmark price elevated in these neighborhoods, which other home sellers are chasing. So again, this is another factor that kind of keeps the prices sticky or, a little elevated rather than pulling it down.
Makes total sense. One thing I'll just throw in is that a lot of times I'm reading an article and it will say something like, oh, from last quarter or from last year, foreclosures are up 5%, they're up 10%. And on the surface, that sounds alarming.
Right.
But then when you start looking at the data, it's not really alarming at all. And as an example, in second quarter this year, there were 53,000 new foreclosures in the United States. There were 71,000 back in 2019 prior to the pandemic. So they're still significantly lower than prior to the pandemic. And back in 2007, 2008, there were 475,000 foreclosures. So it's very, very, very significantly lower than we had back during the 2007-2008 downturn, and it's even much better than we had prior to the pandemic.
So another factor to contrast with the 2007, 2008, 2009 housing market is there was significant new construction going on back then. In fact, the housing starts in 2007 were 3.5 million, and in 2008 it was 3.1 million. Now, housing starts are the new residential projects that began in a specific time period. And if you contrast it with now, it's less than half. It's around 1.3 million per year. So that's a huge reduction in the new supply that is in the market. And what happened then also, as you pointed out, there was a lot of subprime mortgage loans that were happening. So people with sketchy financial histories could just secure a loan. And so defaults started happening. And these defaults snowballed so much that home prices crashed. And you know what happened then. Prices crashed. Many folks lost their homes back then.
Nope, totally agree with that. So if we come forward to today, where does this leave us? Well, Construction is modest. I think when we look at the big home builders, they don't have hundreds and hundreds of new home communities in all directions around major metro areas anymore. It's just one or two here and there. So they're being very cautious, very conservative by adding that. Lending, as we've mentioned, is very, very conservative. And anybody that's gotten a loan in the past 5 to 10 years will tell you it's very difficult to get a loan, even if you have great credit score, great income, and all that. It's still difficult to get a loan. Owners are in current homeowners are in great financial shape, as we've spoken about. So they have no desire to sell their house if they don't really want to or have to or get the price that they want. And defaults are minimal. Foreclosure rates are not going through the roof, even though they may be up slightly year over year. They're up slightly from a very low historic level, and they're nowhere close to what they were back in 2007, 2008. So even though right now we have sluggish demand, prices are holding on because supply is equally tight. And owners, we've talked about this in previous podcasts, that do have mortgages, oftentimes those mortgage rates are very low, like you said, 3%, 4%, 5%. So they don't really have an incentive to turn around and get a new mortgage at 7% at a new property. So there's just really a very, we're almost at a stalemate, I would say, in terms of the market. What is the key for our conversation here today, I think, to remember is just because we're seeing weaker demand, that doesn't mean prices are going down. That's just one part of the equation. Economics 101, you talk about supply and demand. Supply is still low, so a drop in demand isn't really triggering a big price reductions. So that maybe leaves one variable that people keep looking at. What could get more sellers to re-enter the market? I just read an article this morning in the Wall Street Journal on this, and they were saying, if we can get interest rates down to the less than 5.5%, we've said less than 5%, but the bottom line is significantly lower than they are today. That could then perhaps stimulate some more supply from folks who now say, okay, I can put my house on the market. I can go to another house. I'm not going to have to settle for a really high interest rate. That might stimulate some supply, which could then, maybe unthaw the market a little bit. We've said we don't really see interest rates plummeting like that. Of course, there's things that could happen in the future that might cause that, but right now our forecasts are for pretty stable rates, staying above 6%.
So there you have it. We have a slow market, but prices are also elevated. They remain kind of sticky because both sides of the equation, demand and supply, are holding tight. So we'll keep tracking the data for you so you don't have to. Thanks for listening to On the Pause. Thanks for listening to On the House. I'm Reena Agrawal. See you next time.
Thank you. I'm Eric Fox.